Most traders fail not because they don't know how to predict direction, but instead because they don't manage their risk. Trading without managing your risk is literally like playing with fire, and guess what happens when you play with fire? It's just a matter of time before you get burned, and when you get burned, it hurts. But it doesn't have to be this way. There are thousands of traders out there who are this close to trading profitably and confidently, but they're just missing one small piece to the puzzle. In today's video, I'm going to show you how to manage risk going forward so you can trade profitably and confidently. Towards the end of the video, I also have a bonus that can even help you get better entries. So let's get right into it. Alright, here we go. Now before we get into the technical details, we're going to keep things nice and simple, and let's, for a second, pretend we all had this magical coin where you could flip it and it's either heads or tails. When it lands on heads, you make 40%. When it lands on tails, you lose 30%. Over time, this game will make money, right? Because when you win 40%. When you lose 30%, right? Nice and simple. That is exactly how trading is done when risk is managed. When risk is not managed, instead of winning 40% and then losing 30%, you might lose 50% or 70% or 100%, and then the coin doesn't seem so magical anymore, right? It's not really a coin you want to be flipping. So let me show you how to start flipping the coin the right way, but in trading terms. So basically what I'm about to show you works for day trading, swing trading, stocks, options, futures, forex, basically every single type of trading. And essentially what you're looking for is no matter what, you need some sort of stop loss, right? And if you don't know what a stop loss is, essentially it's a point at which, you know, the stock is not going in your favor anymore, and you just say, you know what, I'm done, I am exiting, right? There are a million different ways to configure a stop loss. It can be a set level, like let's say, you know, on Coinbase right here, it could be an $80 level. It could be a percentage. If you're trading options, it could be a level on the option. It could be a percentage on the option. You can do trailing stop losses. You can do a million different things, but I'm going to show you what I do. So basically, there are two different routes I take. If I'm trading a stock and that stock is going ballistic and it's moving with some serious power, then normally what I do is I will base my stop loss off of a specific level that that stock has for the day. For example, Coinbase was moving with more momentum than any other stock in the entire market today. And let's say, you know, I was trading Coinbase to the upside. And let's say we go, you know, we're on a 1 minute chart. And like, let's say I decided to enter Coinbase right around here, right? It's not the perfect entry, but, you know, not horrible. What I will do here is I'll say, you know what, I'm looking at Coinbase, you know, right now it's at $87.50 a share. I see that $85 is a pretty big support level. It's not too far away either. So I'm going to set my stop loss at 85. If Coinbase hits 85 or lower while I'm in that trade, I am getting out. And while I would love to hope that Coinbase rises at some point later in the day, if it hits my stop loss, I am out. End of story, right? And, you know, from that point, either Coinbase will either hit my profit target or it'll hit the stop loss. And if it hits the stop loss, I am done, right? Now, that's one way to do it. And basically what I did is I just based the stop loss off of a major level that the stock has, which is $85. It's a pretty big support level. It's a, you know, pretty decent point at which the stock touched earlier in the day. And, you know, that's how I do it. Now, if the stock is not necessarily moving with some like serious power or serious momentum, you know, I trade options a lot, so I will just base my stop loss off of the option. So let's say we jump over to Tesla for a second. It has had a pretty wild day so far. And let's say I was trading the Tesla 220 strike call options. And let's say I'm buying the dip on these call options. And let's say, again, let's say I don't have the best entry in the world, but, you know, it's decent. And let's say I buy these call options right around $280 each, right? 2.80. Normally, for like day trades, I like to have stop losses around 20% for options. So, you know, if my stop loss is at, if I entered the trade at $2.80, my stop loss would be around $2.24, right? So, you know, not bad. And, you know, either from that point, when I enter, the stock will either bounce up and these options will start to move, or the stop loss will trigger. And whichever one of those happens, I'm going to stick to my plan. I see so many traders that, have stop losses, but they don't follow them. And having a stop loss is exactly like, we'll say, having a backup parachute while skydiving. When shit hits the fan, when things don't go how you want them to go, you want to rely on your backup plan, right? And the stop loss is your backup plan, just like a backup parachute is your backup plan while skydiving. But guess what? That backup parachute doesn't do any good if you don't actually use it. And stop losses are the same way. So once you have a stop loss, you have to respect them, you have to follow them, and most of the time they will protect you. Now, there are some times in trading where, let's say I go back to this Tesla example, and this is actually a perfect example. So looking at Tesla here, let's say I got in these call options at $2.80 and my stop loss was at $2.24. And let's say I would get my stop loss would trigger right here, but then the next thing we know, the option reverses again and starts trending higher. While this sucks to see, no matter what stop loss you choose, whether it is a 3% stop loss or a 98% stop loss, sometimes your stop loss will trigger and the stock will reverse and do exactly what you wanted it to do from the time you entered the trade. And while this sucks, most new traders will have this happen and they'll want to freak out and change their whole strategy, and it's just a giant mess. Where traders who know what they're doing realize that this happens no matter what, and that most of the time your stop loss will save you from further losses, and every now and then, it'll prevent you from further gains. But with everything being said, stop losses are crucial, they're necessary, and they are there to help you. So keep that in mind. If you can focus on keeping your losing trades as small as possible, trust me, the winning trades will take care of themselves and it'll work in your favor. Now that we got that out of the way, it is time to talk about the second most important thing when it comes to risk management, and that is position sizing. So you will never hurt yourself by going smaller on a trade than you think, but you can definitely hurt yourself by going heavier on a trade than you think. So when in doubt, enter with a smaller amount of capital than you think you need, right? You will never go wrong that way. Now, there is no magical number, no magical formula, no magical percentage that tells you the exact amount to risk on each trade. Just make sure no matter what happens, you are never in a situation where, you are so heavily into a trade that you can't think straight, because it's not good for your body, it's not good for stress, it's not good for your P&L. It doesn't help anything. So when in doubt, go lighter in a trade. Once you have, your strategy perfected, you can go as heavy as you want and, you can rock and roll. But until then, go smaller than you think. Managing risk is really what separates a lot of traders from, consistently and confidently growing their accounts. And a lot of that has to do with discipline. So, while it's not the most exciting thing ever to see your account not really move too much, if you're going in the right direction, you can always add more to your positions. You can always go heavier in the future. So keep that in mind as well. Now, here's the bonus. And basically, this is something very, very important, especially when it comes to short-term trading. I think we can all admit that nobody, not Warren Buffett, Ken Griffin, any market maker, or anyone can perfectly time the tops and bottoms. It's just impossible. And I think that it's very important that our trading styles actually reflect what we believe in. For example, let's say we're looking at Apple for a dip buy day trade. And let's say we notice support at $171.80. We might go to this chart and we might say, all right, we see support right here at $171.80, but who really knows if this support's actually going to hold, or if it's going to be a fake out, or what's going to happen? So instead of trying to perfectly time the bottom of the stock by buying right at support, we don't have to play that game. Instead, we can enter into the trade over the course of multiple trades and in turn get a better average price. For example, instead of just buying the support, or just buying the stock at $171.80 right here, we might buy half now and then another half of our position, if the stock dips, a little bit more, or if it falls by a certain percentage, right? You can configure that however you want, but the main point is instead of just entering into your trades with one big trade, break it up into halves or thirds or whatever you want. So in this example, we might buy half right at $171.80, which is the support, and we might buy the other half at $171 and let's say 55 cents. In turn, we bought Apple, but it was in two different trades. By doing this, we got a better average entry price because instead of just buying at $171.80, we bought some there and then some at $171.55. In turn, it takes emotions out of the trade because we're not focused on, perfectly timing the top or bottom. It literally directly impacted our P&L because we got a lower entry price. And in turn, it just makes it that much easier to profit, mainly because you're not super focused on being perfect. And that's okay because no one can be perfect 100% of the time while trading. So, entering and exiting your trades, instead of just one big trade, breaking them up into, two smaller trades or three smaller trades can help a lot. So consider doing this going forward. It's called scaling in and out, also averaging in and out. Like I said, it really helps with emotions and just getting better average entries and exits. So now that you know how to manage your risk, it's now time to, respect your stop losses, create stop losses and just follow them, right? Managing risk is the most important thing for trading. If you can keep your losses as small and as minimal as possible, the winners will take care of themselves. Now that you know how to manage your risk, I definitely recommend watching this video on the screen right now. It talks about, the things that no one else talks about when it comes to support and resistance, and it even helps you avoid fake breakouts. Check it out.